Okay, this is a video going over the Chapter 1 most missed questions on the Chapter 1 exam. Let's go on our first question. ABC Company's balance sheet reported assets of $57,000, liabilities of $18,000, and common stock of $15,000 as of December 31st, year 1. So there's our December 31st, year 1 accounting equation. Let's plug in what we know. We know assets are $57,000. We know that liabilities are $18,000. We know that common stock is $15,000, and we can find retained earnings by adding these two together, $18,000 and $15,000, subtracting them from $57,000, and we'll get $24,000, because the left side of this equation, which is $57,000, that's the asset side, has to always equal the liability equity side, which in this case, all three of these pieces add up to $57,000. Now, what they want to know is, what was the amount of net income for year 2? Remember, this is at the end of year 1, which is the same thing as the beginning of year 2. So here is at the end of year 2's accounting equation, and what we're trying to find is something that happened in here between beginning of year 2 and beginning and the end of year 2. And what happened was the company earned money, and the way they figure this out is you take the beginning retained earnings, and we'll plug in some more things that we know now. We know that the ending retained earnings were $30,000, so retained earnings went up $6,000 during year 2. Now there's only one way they can go up, which is to have income, and the way that retained earnings goes down is to pay out dividends. So it looks like the company paid out dividends of $17,000, and it's still the retained earnings still went up $30,000. That $30,000 is after everything had happened. That is, after all the income and after all the dividend payments. So what we're trying to find out is, what is net income in year 2? So 24 minus the dividend payment plus whatever net income was had to equal $30,000. Well, if it went up $6,000, even still after you paid out this dividend of $17,000, the net income must be the difference between that $17,000 and the $6,000 increase, which makes it $23,000. And you can check this by saying 24 minus 17 plus net income of 23 should equal 30, and it does. Let's go to our next question. This question wants to know, what would the amount of expenses be on the income statement? All right, it says the year-end financial statement of ABC Company contained the following elements. They had, let's put our accounting equation up here. Remember, this has always got to be in balance, and it's always got to be in balance at every point in time. And so they gave us the year-end information for this company. So it says here that year-end assets were $38,000. Liabilities, we don't know. It also tells us that we had year-end common stock of $68,000, and it also tells us that we had ending retained earnings of $8,800. Now, we can figure out what liabilities are, but let's just see if we even need to do that. What we want to know is, what were the expenses during this year of operation? So here's something to keep in mind. They did tell us that the beginning retained earnings at the beginning of the year was $46.50. Now, if you remember anything from the previous problem, if your beginning retained earnings are $46.50 and your ending retained earnings are $8,800 during this year, that means that retained earnings went up, and the way they go up is by having income. The way they go down is by having dividends. Now, did we pay any dividends? Yes, we paid out dividends of $16.50. So let's see what we got here. We've also, like I said, net income is a product of revenues minus expenses. So from our beginning retained earnings for year 1, we added revenues during this year of $14.6. And what else? We want to know what expenses were, right? So that's the question mark that we're trying to figure out. And we also know that we paid out dividends of $16.50. So what I'm really trying to figure out is this. If I began retained earnings at $46.50, I had revenues that increased retained earnings by $16.5, expenses that are going to lower retained earnings by I don't know how much, But I do know that dividends were $16.50. That's reduces retained earnings, and I also know that the ending retained earnings, after including all of these things, ended up being $8,800, which, like I said earlier, was an increase. So all I've got to do is say 4650 plus 14.6 minus something minus 1650 equals $8,800, and I'll do that. I'll do that horizontally. Might be easier to see. Beginning returning earnings 1450 plus revenue of 14.6 minus expenses of we don't know minus dividends of 1650 equals $8,800. Now we're solving for the unknown, which is expenses. We're combining all these things right here, which is this plus the 14.6 plus 1650, which is going to be a net 17.6 minus expenses equals $8,800. So 17.6 minus what would give you $8,800, and the answer is expenses have to be $8,800. And you can plug this back in to right here, and you'll see that it all checks out. Next question. Before we get to the next question, the next several questions deal with the classification of cash flows. And just to give you a real good general overview of this, there's three kinds: operating activities, investing activities, and financing activities. And really, cash flows, what we're dealing with here is what happened to your cash, where is it, how much do you have as a beginning balance, as an ending balance, and how much did it change? And that's called a cash flow statement. I'm not going to get into a cash flow statement any other right now, but for this situation, you need to know this. Operating activities, when it relates to cash flows, are any kind of cash that came into or went out of the balance sheet, which really are revenues and expenses. So income statement items are operating activities as far as cash flows. Investing activities are things that have to do with either buying or selling long-term assets. And by that, I'm talking about equipment, or I'm talking about land, building, that kind of thing. And then the third type of cash flow that a business gets is what's called financing activities. This would either be issuing or repurchasing their stock, their common stock. That's one type of financing activity. Issuing or paying off debt. That's another type of financing activity. And the third type of financing activity would be dividend payments. So operating activities are income statement items, revenues and expenses. Investing activities are buying or selling assets, long-term assets. And the financing activities are either buying or selling stock, repurchasing stock, whatever, taking out debt or repaying debt, and then also making dividend payments. Keep those three things in mind on these next several questions. So, ABC Company earned $3,300 of cash revenue, paid $1,900 for cash expenses, and paid $650 for cash dividends to its owners. How much is cash flow from operating activities? Well, operating activities are things on the income statement. They're revenues and expenses that are cash revenue and cash expenses. So, cash revenue and cash expenses, like I said, are operating activities. Paying dividends is a financing activity, as you can see over here, like issuing or repurchasing stock, issuing or repurchasing debt, or dividend payments. Those will all be financing activities. We don't care about those. So the answer here is going to be $3,300 for revenue, minus $1,900 for expenses of cash. That's going to leave us with $1,400 net cash inflow from operating activities. And that's your answer. During year 2, ABC Company earned $2,750 of cash revenue, paid $1,200 of cash expenses, and paid $700 cash dividend to its owners. Based on this information alone, how much did cash from financing activities change? Okay, cash from operating activities went up by $1,500. That's the cash revenue minus the cash expenses. That's good, but we don't want to know that. All we want to know is financing activities, which were these dividends that were paid. So cash from financing activities decreased by $700 because you had to pay out these dividends to the owners. Retained earnings at the beginning of and end of the accounting period was $700 at the beginning and $1,500 at the end, respectively. If revenues were $2,700 and dividends paid to stockholders were $600. Expenses for the period must have been how much? We don't know. Okay, this is one of these things where if you know most of the pieces except for one, you can solve for the unknown piece. So in this problem, we're going to use the accounting equation, and we're going to look at the equity section. And within the equity section, we're going to look at things that change retained earnings. So beginning retained earnings, $700 from up above. Next, we had ending retained earnings of $1,500. So you know that retained earnings went from $700 to $1,500. And here are some things that caused that. First of all, revenues make retained earnings go up during this period $2,700. You also know that expenses, that's the unknown, so we'll put a little question mark there. And dividends made retained earnings go down because you pay out dividends. They made them go down by $600. And when all the smoke cleared, we went from $700 up to $1,500. Now, there's lots of ways to work out how do you come up with expenses, but here's one of them. First thing I did was I took the $700 plus the $2,700, so it was the beginning retained earnings plus the revenues, and got a total, which is $3,400. Then I took the $3,400 and subtracted out $600 worth of dividends, and I got $2,800. Now, I've got $2,800, and I know that my ending retained earnings were $1,500, so the difference between those two, between that $2,800 and the $1,500, should be my expenses of $1,300. And you can check yourself by plugging in $1,300 right here in a minus, and see if it doesn't all come out to be, from beginning to end, if it all doesn't add up mathematically. Okay, this question wants to know what would be the net cash flow from operating activities. Remember, that's the things that are going to be only appearing on the income statement, right? Revenues and expenses. So we go through this list here, and we go through the accounting equation, and we'll go through these transactions this time, and then we'll pick out the things that would only appear on an income statement. That would be revenues and expenses. So issued stock for $68,000, assets go up, equity goes up under common stock. Borrowed $39,000 from the bank, assets go up under cash, and liabilities go up. Provided consulting services for $66,000. That's a revenue transaction. Assets go up under cash, and equity goes up under revenue. Then we paid back a $29,000 bank loan. So cash goes down $29,000, and liabilities go down $29,000. Then we paid rent expense for $16,000. That's operating activity. That's going to be on the income statement as an expense. Cash goes down $16,000, and expenses go down $16,000. Then we purchased equipment for $26,000 cash, and that's one of these things where assets go up when you buy the equipment, but assets also go down when you look at the fact that it was paid for by cash. So cash goes down under assets, equipment goes up under assets, and overall assets don't change. Next, we paid $4,400 dividends to stockholders. So cash goes down $4,400, and equity goes down under dividends of $4,400. And then last but not least, we paid employees salaries of $35,000. So cash goes down $35,000, and equity goes down $35,000 as an expense. So operating activities would be $66,000 from consulting services, that's revenue, minus the outflow for rent expense, which is $16,000 we paid for that, minus the salary expense we paid for $35,000. So combining all these things together, our net cash flow from operating activities would be $15,000, and it's a plus, so it's an inflow. ABC Company began operations on January the 1st of year one. During year one, the company engaged in the following transactions. So you got 8 transactions here, and they want to know what is ABC Company's net income for the year. Well, net income is the product of revenues minus expenses. Revenues, you can only have a revenue if you have a customer, and you're going to sell a customer either a product or a service. So let's go down through here and see what are revenues. Also, expenses are things that you spend money on so that you can generate revenues.
So let's see what we got here. Issued, first of all, let's get the accounting equation up here. Issued stock for $58,000, that's not a revenue transaction. Borrowed $34,000 from the bank, that's not a revenue transaction. Provided consulting services for $56,000 cash, that's a revenue. You're selling a customer a product or a service. In this case, it was consulting services. So what happens? We have revenue, and that goes over on the equity side. We paid rent. We paid the bank back $24,000 loan. That's not a revenue transaction. There's no customer involved in that. There's nothing going on with revenue there. We paid rent expense for $13,500. That's an expense, and that goes on the income statement. So that's a minus there. We purchased equipment for $21,000 cash. Whenever you buy equipment, you're trading one asset for another. You're trading your cash for another asset called equipment. So that's not a revenue transaction. Besides, there's no customer there. We paid $3,900 dividends to stockholders. Again, that's not a revenue transaction. We paid employees salaries of $30,000. That is a salary expense, and that is definitely an expense. So we've got one revenue, two expenses, and the net income for this situation is $12,500.
Next one. They want to know what would be the ABC retained earnings account balance at the end of year one before the process of closing accounts has been undertaken. This could be considered a trick question if you are not very familiar with accounting or have not read very well deep into this. And so here's what the answer basically is. Since the closing process has not been completed, that is, we haven't done anything to close the books, the retained earnings account balance at the end of the, and this is important, at the end of the, and this is important, at the end of the first year is always going to be zero. When you first start a business, retained earnings is zero until you start adding income into it. So if you haven't closed the books, so the question wants to know the ABC retained earnings balance at the end of year one before the processing closing accounts has been undertaken, it's zero.
ABC Company engaged in the following transactions during year one, its first year of operations. Assume all transactions are cash, and they want to know the amount of total equity on ABC's balance sheet at the end of year one. So let's go through these transactions, put up our accounting equation. We acquired $1,450 cash from issuing of common stock. So cash under assets go up, and so does equity under stockholders' equity. Borrowed $920 from a bank. Well, that cash goes up, but so do liabilities and not equity. We earned $1,100 cash revenue, so cash goes up $1,100, and so does equity $1,100. We paid expenses $350. Expenses would be a cash expense, so cash is going to go down under assets, and equity is going to go down under expenses for $350. And then we paid a $150 dividend, so cash is going to go down under assets, and equity is going to go down by $150. So let's recap this. So to get our total amount of equity on the ABC balance sheet at the end of year one, start with the beginning balance of equity is going to be zero because it's year one for the company. Add common stock, add also the revenue, subtract off the expenses and the dividends, and the answer here is at the end of year one, total equity for ABC Company's balance sheet will be $2,050.
Next, they want to know what is the amount of retained earnings on the ABC Company's year two balance sheet, year two. So we have ABC has transactions for year one, they have transactions for year two, and they want to know what's the retained earnings balance at the end of year two. Well, first thing we're going to do is we're going to start off with the retained earnings balance of zero, and then we're going to add things and subtract things from year one that are going to affect retained earnings. And the only things that affect retained earnings are revenues make it go up, expenses make it go down, and dividends make it go down. So from these transactions here, we've got the following. Plus $1,500 for revenue, that's $1,550, minus expenses of $440, right? And paid out a dividend of $240. We don't count issuing common stock because that has nothing to do with retained earnings. And we don't count borrowed money from the bank. That only affects cash on the asset side and liabilities. Look up past transactions, you can see. So when we combine all these pieces, we end up with an ending year one retained earnings balance of $870. That's important because we're going to carry that balance forward into year two because we need the amount of our retained earnings balance at the end of year two. So at the end of year one, same thing at the beginning of year two, 870. We want the ending balance of retained earnings. So we're going to go through these transactions and pull out the same things. What things affect revenue, affect retained earnings from these kind of transactions? And we know when there's our starting point, 870, we'll add revenues, which would be something that's going to increase retained earnings. We'll subtract out expenses, which reduces retained earnings. And we'll also reduce retained earnings by paying out dividends. So our end of the year retained earnings balance for year two, combining all these things together, would be $1,540.
Okay, ABC Company engaged in the following transactions during year one, its first year of operations. Assume all transactions are cash. And so what we want to know is we've got this first year of transactions, we got the second year of transactions, and they want to know the total assets on ABC's balance sheet at the end of year two. Well, let's go through and do all these and figure out what things are going to affect assets. So here's our assets have to always equal liabilities plus equity. And our first transaction has to do with issuing a common stock for $1,300. That increases assets by $1,300. We borrow $770 from the bank. That increases cash or another asset by $770. We earned $950 of revenues, so that'll increase cash, an asset for $950. Also under equity, it increases that for $950. Paid expenses for $320, so we got $320. It's going to subtract off of that for we'll subtract out of cash, which is an asset, and also it lowers equity. And then we paid a dividend for $120. That reduces cash, does the asset cash by $120, and also equity by $120. Now add all that up. We start with the ending year one asset total of $2,580. Now we're going to go through the same thing for year two. Year two, we have additional common stock that was issued for $675. So assets under cash go up $675, and also under equity. We've repaid part of the bank loan, so that cash goes down now under assets $465, and also the liability goes down $465. We earned revenue of $1,100 cash, so cash goes up $1,100, and so does equity $1,100. Incurred expenses of $500. That means our asset cash will go down $500, and our equity goes down $500. We paid dividends of $170, so $170 goes down under assets for cash, and also equity go down. And so when you add or combine all these pieces in year two to year one's balance, you get an ending asset total of $3,220.
Next transaction. This one they want to know, what is the net cash flow from financing activities for year two? And just to refresh your memory, a financing activity could be any one of the following things. When you buy or issue stock or repurchase stock, when you have new debt or pay off debt, or when you pay out dividend payments. So when you look through these transactions right here, here are the financing activities. They are cash inflow for issuing stock, $1,000 right there, that first transaction. Next one would be $1,650 for cash outflow of a loan repayment, which would be this $1,650 right here. Then we've got $1,240 cash outflow for dividends. That was this one. And that's our total, which is going to be a total net cash outflow since it's a minus number here. That should be a minus in there somewhere. Cash outflow for financing activities are $1,890. What we didn't include in here were expenses, which is something that goes on the income statement, which is an operating activity. And also we didn't include revenues, which again is another operating activity. All they wanted were financing activity.
ABC Company engaged in the following transactions during year one. Its first year of operations. Assume all transactions are cash transactions, and they want to know the amount of retained earnings on ABC's balance sheet at the end of year one. So what things affect retained earnings? Well, let's go through here and see. We acquired $4,500 cash from issuing common stock. Common stock is one of these things that under the equity section that's common stock and retained earnings. And so issuing common stock does not affect retained earnings. It affects equity, but not the retained earnings portion of it. We borrowed $2,950 from the bank. So if we borrow money from the bank, cash goes up and so do liabilities, but that doesn't affect retained earnings or the equity section. We earned $3,850 revenue. Well, cash goes up $3,850, and so do revenues under retained earnings under the equity section. So that's one of the things that will affect it. So if you start with the beginning balance of retained earnings for year one, because it's the first year of business, and you want to add revenues to it, that's the first thing we'll do. Then the fourth transaction, we incurred $2,550 worth of expenses. When you do that, that means that cash is going to go down under assets and retained earnings are going to go down because that's something that affects the retained earnings. So expenses minus $2,500, and then paid dividends of $550. So when you pay dividends, cash goes down and retained earnings goes down $550. So the ending balance at year one, retained earnings, would be $750. Okay, ABC Company engaged in the following transactions during year one, its operations. Assume all transactions are cash, and they want to know what would be the total liabilities on ABC's balance sheet at the end of year one. Okay, so whenever you acquire $4,200 of cash from issuing common stock, assets go up, and so do equities go up. It has nothing to do with liabilities. We borrowed $2,800 from the bank, so cash goes up under assets, and under liabilities we have a increase for $2,800, and that is a liability. We earned revenue, that's not a liability. We incurred expenses, that's not a liability. We paid dividends, that's not a liability. So the answer here is going to be borrowing money from the bank means our ending liability balance will be $2,800.